Hope you and your families are doing well, and thanks for joining David and I for this month's market update for the month of September. David, how did the investment markets perform in the month of September?
Overall, equity markets had a bit of a tough month in September, Harry. Global equity markets broadly were negative. It was one of the worst months in the last 18 months. In fact, since going back to March 2020, it was the biggest drawdown. So in the United States, we saw the S&P 500 was down at almost 5%, 4.76% to be exact in September. That was one of the worst performing markets was the US equities. Canada, by comparison, was a little bit better, only down about 2.5% in September. European and Asian markets were not immune to the downward pressure either. Depending on which index you were looking at in Europe, they were down low single digits, anywhere from 1 to 4% roughly. Asia, the Asia Pacific region was down similar to Canada, around 2.5%. The lone bright spot in September was Japanese equities, were one of the only major developed markets that actually posted some positive returns. Japanese equities were up about 3% in September. Harry, how can we make sense of the poor performance in the markets in September?
David, that's an excellent question. And as we know, markets can't perform straight up all the time. And in recent months, we've sort of been expecting a little bit of volatility because of the length of this uninterrupted sort of straight up movement that we've seen in the market. I mean, if we were to look at some numbers, until recently, the S&P 500 has gone 317 trading days in a row above their 200-day moving average, which is a record for how long it's been actually going straight up. And there's been a number of reasons for that. I mean, we've taken a look at some of the things that have caused people to start worrying about, like China. People are worried about China. They're worried about the pandemic. There's a debt ceiling that's come back up down in the US that people are worried about. And of course, some of the different tax legislation. So there's just been a number of things that have come on that are now on people's minds. Maybe we're finished with summer and everyone's spending a little more time indoors and have a little bit more time to look at it. But the media always loves to take advantage of these opportunities to stir up people's emotions. And we're seeing that happen right now. David, how should investors feel about September's pullback?
That's a great question, Harry. Obviously, many investors probably feel concerned about the performance in September. I know I've fielded a few calls in the past couple of weeks here from people noticing little drops in their portfolios. And certainly that's normal. And obviously, as you mentioned too, the media does a great job of sensationalizing anytime we do get a little bit of a hiccup in the markets. But it is important for people to remember corporate profits have been excellent the past couple of quarters. That hasn't suddenly changed here in September. As you mentioned, there are just a few things now that have popped up on investors' radars, from issues with China and a particular company in China with a debt burden. Obviously, looking forward, people are expecting that interest rates will start to go up. Federal stimulus in terms of bond purchases will start to wane. And so that will be a bit of a headwind for all asset classes, equities, real estate, but in particular, we feel for bonds. So we do continue to favor the equity side. We do consider that equities have more upside at this point still than the bond market over the next 12 to 18 months. And it's important, even though people may feel concerned with the performance in September and maybe a little bit worried, that's normal to feel that way. It's also normal to have these types of corrections. You know, a 5 to 7% correction is by no means out of the norm. It happens quite frequently. We haven't had one for about 18 months now, but lo and behold, we have had one, and it's no surprise. As you mentioned, from a technical standpoint, the markets had been quite hot the last number of months. So we've had a little pullback here. You know, you have to remember that the portfolio managers will take advantage of these opportunities. If they have a little bit of cash in the portfolio that's built up from dividends in previous quarters, they'll look to spend that on quality businesses and reinvest that money. If for you yourself, if you have a little bit of cash lying around in a bank account that you may look to invest, you may want to do that sooner than later on a bit of a downswing here. Also, a lot of people wait till the end of the year to make lump sum RSP contributions, which is from a cash flow perspective may just make sense. With bonuses coming at the year end, people will typically put those bonuses in January or February. But if you do happen to have a little bit of money available and you know you're going to make that RSP contribution when the markets are down a little bit, like they have been in September, now maybe be the perfect time to do that. So whenever there's a little bit of a hiccup, there's also opportunities in the markets.
Yeah, super points, David. And I want to reiterate a couple of those points. Number one is the money managers definitely take advantage of these opportunities. You can as well. The second thing is remember, David and I always take these type of market volatilities in mind when we're building your financial plan. And if you remember the 3 balls that I always draw, that's the reason why we have them, is because we expect market volatility. We also expect the money managers to take advantage of that volatility. But as always, if you have any questions, you want to review anything, please don't hesitate to give David or myself a call.
Thanks. Take care. Till next time.